What's up, Internet? Bubble Stock Market Show for Wednesday, October 22nd, 2025. The closing show. We got the broad markets pulled up here, and overall, the stock market's having a down day. Got all the indices, the VIX kind of gapped up and got up here around 20 on the VIX future, and on the regular VIX, it got up to I think around 20 as well. Numbers pretty close, although about $1, a little bit less than $1 off right now as far as the futures VIX and the regular VIX. Oil is having a bit of an up day. Bitcoin stock market's down a bit of a down day, and gold and silver at the moment putting in a bottoming tail candle. We'll see how that continues to go. It doesn't really matter though if it when it comes to paying your bills. Do you really care if you made money when the stock market was going down to pay, let's say, to fill up your gas tank? Do you care if that money was made with a downward position in the stock market or an upward position? Will the gas station charge you more money if you're paying with money that you made from a down position? No, they won't. They're going to take your money either way. So in a way, if you have no emotional value on which way the stock market goes, and you just realize that you can extract money out of the stock market regardless of which way it goes, then if you ultimately you're using the stock market to pay bills, make money, however you want to word it, something to do with extracting units of currency out of your brokerage account so you can go do something with that currency. If that's your goal, then if the stock market goes down, it wouldn't really make sense to say there was a bad day in the market. So a lot of times that's what people do. They look at the stock market as like the only good thing is it for it to go up. So in a case like today or the last couple of weeks, they feel like, oh, the stock market's not doing good, not doing good, because they're defining good by going up. So I'm just I'm pointing out that some people do that, and hopefully, if you have not been fully aware of this before, hopefully you can take this information and decide for yourself if you want to assign a good or bad meaning to a direction in the stock market, or if you want to remain emotionally neutral to directions in the stock market and remain attached to extracting currency out of the stock market, because those are two different attachments. I get it, it's splitting hairs, but sometimes that's what you do. If you look at the structure of an option price, they're made up of Greeks. They're like different aspects of one option split into hairs. These different Greeks are each different hair. So it's up to you, but I find being surgical and strategic, especially in the thinking. And speaking of the thinking, I got the Intelligent Investor book right here. Hopefully, you can hear that. That's the book. This copy, all what is the printed page? All the index starts on page, looks like 331 is the last page. Oh, 331, 333. Okay, all 340-ish pages of this book. The 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 reason why I wanted to bring up this book is that is it's you know what? I got so sidetracked with how many pages were in the book, I forgot exactly why I was bringing up the book. So we were talking about having an emotional reaction or an emotional assessment, to correlated with direction of the stock market. And you can choose to do that if you want. It's actually it's something that a lot of people don't choose. We're sort of just kind of indoctrinated into this way of thinking. That's generally in the US society, that's kind of the way things are structured for this sort of like societal overall belief system that when it comes to financial assets, up is good, down is bad, and it's just that black and white. So again, what I'm saying is up is good, down is good, sideways is good because you can make money from any direction. So if the money that you make from an up direction is just as valuable, so $1 is going to buy you $1 of items, whether it's came from a down direction in the market, a sideways direction, or up direction. What does it matter? They're all good. So with all that philosophical ranting that probably might not have made a lot of sense, I'll probably have to figure out a way to become more eloquent in explaining my thought on that. Let's go down here to theta options. So when the stock market's going down, if you already have stocks in mind that you want to buy, and some of the criteria that you can use to buy them is just general fundamental criteria. I have it here for a variety of stocks. We can do one together, and I'll show you exactly how it's done. So I added this one today. I added Hood. See the PE, like if we're looking at a kind of an average of 25, 51 PE. I think this is that Nvidia? Oh, Netflix. We got a 51 almost 51 and a half of PE for Netflix, and Hood is over that. So Robinhood, the PE is a bit higher. Peg, lower peg on Netflix, a little bit higher peg on Hood. Enterprise value to EBITDA, 75. If you're looking at 10 is a good deal. Ooh, man, that's high. Look at these margins though. Gross margin almost 100%. Operating margin lower than profit margin. How can that be? I don't know, but I double checked FinViz just to make sure. So I added that, and we could add some other ones. But instead of maybe adding other ones right now, let's take a look at where some potential opportunities might be. So I'll pull this down, just to pull this down for now. And I set this up quite a while ago, several, maybe over a year ago. I can't remember. I I used to be more of a one-trick pony. So for several years, I consistently was just selling cash secured put options on stocks that I wanted to own. Maybe, if I was assigned, I'd sell some covered calls, but for the most part, I was just doing cash secured put options. That's really it. Um, when you take oil, when you take WTI crude oil out of the picture, I was just doing this. For a while I was really focused in on WTI crude oil. However, when Schwab bought Thinkorswim from TD Ameritrade, the margins changed, and so that kind of re made me revamp everything, and I kind of really went back to selling a lot of cash secured put options, and then getting looking for something to some stock to emulate what I had learned on selling the WTI crude oil futures, selling options, basically strangling that. So eventually, that's where I got into like strangling ServiceNow and experimenting with other stocks. But before that, I was really like drawn to these dividend kings, which a lot of these on here are. Not all of them are, but a lot of them are, and mainly just like really kind of establishing a dividend portfolio. And so selling cash secured put options on stocks that I wanted to own at a price that I'd be happy to pay for them. And then it's cool no matter what happens on expiration date. It expires worthless. Cool. I keep the premium. It expires in the money. Cool. Not only do I keep the premium, but I also buy 100 shares of this asset that I wanted. And this was a price that I wanted to buy it at anyways. So it's pretty good, but it's not very buying power efficient. It's not very fast. But it's a very good kind of beginner or busy life trade. You got a full-time job, you got two kids and a wife or whatever, or a husband or whatever you got. Like you got family stuff, you got stuff to do, you got responsibilities to attend to. You can still make some money trading with this. So let's fundamentals aside from the fundamentals. Okay, we'll do one fundamental for Walmart. All right, Walmart. Let me pull up Walmart's real quick. All right, so I'm just going to quickly copy this. I'll put it right down here. Okay, so now we got our format. We're going to do WMT. Let's pull this up real quick. This will make it as fast as possible that I can think of. Okay, we're going to pull up Walmart on FinViz. Just go to finviz.com, put in Walmart. So now we go under here, PE. See the PE for Walmart, kind of expensive, 40.55. And I'm going to do an enter, tab a couple times over. You do it however you want. Now we're going to do the PEG ratio. What's our PEG on Walmart? 4.33. Not anything exciting there. Enterprise value to EBITDA, again, not too exciting. 21 point, where the heck did it go? 64. All right. Gross margin, 24.39%, 24.39%. Ooh, boy, that went right to where I wanted it. Operating margin, 4.18%. Profit margin, 3.08%. And what I have not put into this information here for the bubbles stock market show, shame on me, is the dividends. The dividends. How can we really make a good fundamental comparison on which company we want to purchase if I don't include the dividends, which on Walmart is pretty good. I don't just mean I don't mean this 87 less than 1%. I mean its growth rate. But nonetheless, I'll figure out a way to do that. Okay, so now we pulled up one. Pull them up for. I would do this for any stocks that you're interested in and do them kind of periodically. I'm figuring out how often I'm going to do this because I did I think I can't remember which ones I did first, but I obviously I just added this one and Mo was there earlier. But so any stock though that's a dividend king, I will take a look at. Now, this is a dividend king. It had a big gap down. This big gap. Look at that big gap down. It has not recovered. It's just kind of been trading lower, but it's still a dividend king. And I'm not going to pull up. I'm not going to pull up numbers on this right now. What I'm going to do in attempts to try to be as beneficial as possible to this day. Let me take a look over the other screen. All right. Let me just look at certain aspects of the market. Yeah, kind of. It's sort of a go nowhere day. It's a lot of the stocks, like I'm looking at ASTS, Tesla, Palantir, Hood. Some of them pulled down quite a bit. Oklo, SMCI, FCX. FCX is up a little bit, but not too much movement. A lot of the other stocks that I named, some pulled back more than others, but all their candles today, at the moment at least, with about 18 minutes left of trading, they all have pretty good bottoming tail wicks on them. S&P 500 candle looks like that. So, but as far as today, let's just quickly, let's pop these open, go through some exercises. Actually, we won't do it that way. We're going to do it this way. Let's pull up this right here, and we're gonna. So you have two different windows. One, theta options. This other window we have here, see, it's standard charts. It's not in the grid like I normally look at. Oh, okay, so this is what I like to do. Let's just take a quick look at Walmart. We'll go through and do a speed analysis. So this is the same type of chart. 1 day, well, this is 6 months. 6 months, 1 day. So this is half the amount of time. But we do have these. Let me put these back on. 6 months, 1 day, and I like it because it's got this kind of fast moving average on here. 9 day exponential, 20-day simple. And Walmart, we see overall in the 6 month has been an upward trend. Here's the same we were looking at before, a year. Here's a weekly for 5 years. And here is 15 years monthly. So let's start our search here. Looks like around this area right here is around 100 to whatever, some number in here, some range from less than 100, maybe 97, I don't know, 97 to 100, something like that. But there's this resistance area in here. And right now it's definitely trading on the top of that. And this is a type of stock that if the stock market starts falling apart, money will probably flow into this because it's kind of like considered this sort of like safe stock. Here's 1 year from left to right, 1 day candle with a lot of moving averages. We see it's above all these moving averages. So let's just look for a really quickly, let's look to put on a cash secured put option trade. And this is just going to make an assumption that you have the amount of money. You have the cash to buy it. So we're doing more of an example of how to find a trade versus like trying to pinpoint how much money you have and make a trade to a certain account size. All right, what's quickly grabbing my attention here is this around the, what is this? Probably like right at $100. And let's take a look at earnings. Walmart has earnings coming up in November 20th. So November 20th, we could look at switch over this option chain to Walmart. November 20th is the earnings, so we wouldn't want to use this one day beyond, one day um, 1 day after earnings. We could go with this 23 days at around 100. This is saying there is about a 13.42% chance that this expires worthless. That it, actually, let me rephrase that. This is saying that there's about a 13.43% chance that it does not expire worthless. There's about a 13.5% chance that it expires in the money, and that you would be purchasing 100 shares at the strike price. So 13, 12 delta, which sometimes is called a poor man probability. It's not as accurate as this, but it's pretty darn close, right? Decent amount of open interest. Volume today, we see the highest sold for today was 47. This is a theoretical pricing, which we control up here, and it is pretty handy to use. I'm not going to use that right now because we're going to try to do more, at least one more trade to look at one more. All right, so at the moment, like if we were looking to enter a position right now, but let's say we just choose that we wanted to go with Walmart. Well, one thing that we could do is, since it got 47 today, and let's take a look at how far did it go down. How far did it go down today? So probably, see, it went all the way down here. It probably, that put probably sold for around 47 when it was closer to or at the bottom of here, closer to that number 100 versus further away. And what was the lowest that traded? 105. 66. It had a movement of, so it opened at the low, from the low 105, the high 107. Roughly, it's like a moves, at least today, moved in kind of harmony with this $2 range of the ATR. 100. So then let's go back over here. I'm going to zoom in. This is cone of probability. I'm going to zoom in. So now we're basically seeing today's candle, yesterday's candle, or along the bottom here, you have dates. And on this axis, you have the price of Walmart. In this pinkish, purplish color here, that cone, that is expanding out one standard deviation for every day and going all the way over here into next year. And then the blue one is the same cone of probability, but instead of being at one standard deviation, it's a little bit more at 80. I don't know how much of a 1 point whatever standard deviation that is. Now we're going to use this to help us take another statistical look at the probability of this happening. For example, we just did that over here. A statistical insight is telling us that there's less than 14% chance of this expiring in the money. So it's a low probability trade. It's a high probability. It's actually a high probability trade. It's a high probability of it expiring worthless. I know other people that for some reason, I like to have probability of in the money. Other people like to have probability of out of the money. And it might be, as a beginner, it might be easier to look at that higher number and see that. And I don't know. For me, I like it this way because the delta, a 12 delta, is about a 12% chance of expiring in the money. You take 12, you take 100 minus 12, and then you have the percent chance of it expiring out of the money. It's basically different facet of the same diamond. And then a lot of times I start my search around a 5 delta to see what's going on, and then I'll go up to a 10 and just see where premium is at in relationship to the 5 delta. 5 delta should be about a 5% chance of it expiring in the money. So that would mean 95% chance of it expiring out of the money. And to me, it's easier to set up winning trades, but you got to play with it the way you got to set your thinkorswim up the way you want it set up. Yesterday, I was talking about how when we drive a car, assuming that you have a normal body, and you're just in a normal car, you're going to have a seat, you're going to have a steering wheel, you're going to have mirrors, and we could say a radio, but let's just go with those three things. You're going to have those, and I'm going to have those. I'm going to adjust my seat, my steering wheel, and my mirrors to fit my preferences. So when you get into a vehicle and you're going to adjust those things to your preference yourself, just like here in your thinkorswim. You might like your statistical probability to show out of the money. I like it to show in the money. Whatever, you play with it and adjust it to how it suits you. So we're going to look at the 100, and it's expiring on the 14th. So we're going to down over here. Here's the 14th. See the date, the 14th, and where is the 100 strike price? All right, we are inside. Look at that. We are inside of the cone of probability. So let's look at the chart. So as far as cone of probability, this is showing us that the price that we're selling at, that it's reasonable that it might reach this point. It might go below the strike price because our strike price is inside one standard deviation move in this time frame. Now, if we were to sell it for less days of expiration over here on the 30th, like end of this month, it's out of the cone, both the cones on that one. But in this case, it's in both the cones. So we have what can we do? We could still sell it. Looking at the volume profile. This is 2 years from left to right, 1 day. So the volume profile, you see where these gaps are in here. This is where lots of shares are traded. Where you see a lot of this area, this color, where this black part in here is less shares traded. So looking at the chart, seeing that around this 100 strike price, it's got support there. It's got quite a bit of support. We see the volume of shares, but there's a lot of mass here, right? So if it starts moving down this way, there's not a lot of resistance in this area. There's maybe more mass pulling it down here. Oh boy, let's see. This is weekly, uh, sort of the same, kind of the same thing. We're seeing a bit of the same thing there. And all right, so if one thing that we could do is we could come down here and sell it to 90. It looks like by looking at this 10-year monthly chart, and it's given us an idea that as far as if we want it to expire worthless, selling here at the 90. Now, is there any premium though down there at the 90 for this date? Nope, not really, not right now. Maybe we would have had this, maybe if you sold more time, but we don't want to sell more time because we got that earnings coming up, right? So this is what we're dealing with. So what price would we feel comfortable? That's the thing. What price do we feel comfortable at buying this? If you wanted a lower probability of taking ownership of the stock, you could even try like the 95. You could do anything under 100. There's a good chance that oh, I forgot. Well, we're gonna do one more thing before we do that. There's a good chance that it's gonna expire above 100, but who knows. So let's do this. Okay, we're gonna obviously I'm putting maybe it's not obvious to you. So I right clicked. What did I do? Get this off. So I went to the 100 strike price. And you notice how on my cursor, see where that little arrow is? Look at when I hover over it, it says sell. If I move over here, it says buy. So that's one way that you give you a clue that you're clicking the right button. Also, you're going to sell. We're going to be selling the cash secured put option. So we're going to sell the lower number. You look at these two numbers. If you can't remember the bid or the ask, you sell the lower number, you buy the higher number. The market, the machinery, the mechanism, the system that's putting the market together needs to there needs to be a difference to like fund that system, market maker stuff. And so I click that. It brings up this order entry tool because it says -1 and it's red, and it probably says credit somewhere. I guess it doesn't say credit. Let's see. It doesn't say credit somewhere, but nonetheless, these are the indications that are telling me that I'm selling versus buying. Red and this -1. See green +1, that's the indication of buying versus selling. So I'm selling a cash secured put option. And let's just use a quick example here. So now I'm going to right click on here. I'm going to go down to analyze trade. And let me see if I can. Oh, no, it's not doing it. That's okay. All right, so analyze trade. And let me pull up the risk profile. Let me see if I can detach this risk profile here. Please detach. Oh, perfect. 3 minutes left to trading in the stock market. And everything looks generally the same. Yeah, basically kind of the same. Alrighty, so let me take off one of these here. So you can find this is the risk profile. You find it under the Analyze tab on your Thinkorswim desktop. I detached it because my main Thinkorswim is on a different computer, and I'm recording on this window, so I can watch my real life account, but I don't have to put my real life numbers on the internet. and I'm more dialed in with this one versus the paper trade. Plus, what if I need to do something in real time when I was making a recording? I'll just stop this recording, fly into action. All right. So this is the risk graph for the risk profile and the risk graph right here for our looking at our short 65 Walmart put. And let me go over here. So slices, just make sure that's reset. Okay, now I'm going to do this hamburger icon, set slices, break even, the day after the expiration. You see, this is today's date. This is the day after expiration. So now, interestingly enough, analyzing probabilities this way is telling us that this contract has a 0% chance of expiring in the money, which obviously is not, which obviously is a discrepancy here because that's kind of a significant difference. This says it's got about 13% chance of expiring in the money, while this is telling us zero. And, for me personally, I would probably, if I was kind of interested in potentially buying Walmart this month, I would probably do, or the next month, within the next 25 days or whatnot. I might make that trade. I might make it. Now, is that a great amount of money coming in? Not really. Not really. So making the trade might not be this trade might not be this ultimate return on investment. Might not. It's probably not, especially since we're buying it closer to we'd be selling closer to the low. But let's say we are able to somehow get more money. We don't get the absolute high. Somehow, let's say we're able to get close to that 44 bucks. So we can take a look at measuring this particular trade. Oh, okay, the market is closed. What we could do is to analyze, is this a good use of how good of a use of our buying power is this? So we take the profit, $43.34. I like to do it minus commissions and fees, but do it however you want. Divided by the buying power required. So you're looking at about a 3% return on your money in, what is this, about less than 30 days. A lot of people that are like, oh, that's not much. Yeah, it's not that much until you annualize it. Until not only do you annualize it, but you're also mixing it in with um, other trades. And sometimes what happens is you're mixing it in with, I'm looking for, you're mixing it in with things like this. Almost 27% return on buying power in about 24 days or so, 25 days. Big difference though over here. Like this was, just to be fair, this was a short strangle. So this is two options, and it's a more complex of a trade. So one of the things, and it's riskier, it's more complex, and depending on how you set it up, it could be riskier. It's not necessarily riskier, but it depends on how you are going about it. For some people, it would be riskier. For some people, it wouldn't, depending on your account size and how you're going to manage it. If you're going to buy shares to cover on each side, both the put side and the call side. So you need to be more well capitalized for that. You know what the great news is though? Everybody can get to it. And you get there oftentimes by learning to crawl with this trade right here. Because if you're consistently doing this, making 3% of your buying power, not only are you doing the 3%, but you're learning the skill of being able to analyze using your buying power, comparing trades. I'm not even saying do this with Walmart. I'm saying go through this and write this stuff down with maybe 5 to 7 different stocks and see which one fits is going to give you the best return on your buying power. I guarantee you sooner or later find trades that you're interested in doing that's at like 1% return on buying power in a relatively short amount of time though, up to like, I think three in a short amount of time is usually fairly decent for me. But on stocks like this. So another thing, that's not the only thing to really consider though, because what if you had to buy it? That's only a return on buying power if it expires worthless. So another way to look at it is what would be your return on investment if you had to buy it? Now, in order to do that, then it becomes a bit more complicated because the simple way to do it, some people would do. I think I just deleted that trade. They would take you take that beginning formula. I think it was like $43 and some change, right? Or let's just say 43.50 divided by uh, 100 shares at $100 a share. So divided by 10,000, you'd be looking at not even a 1% return on investment. However, that wouldn't be completely accurate because this is a ideally the intelligent way to do this is you're buying Walmart not just as I'm paying $10,000 and then I'm hoping to sell these shares at a higher price later. And that's kind of like um, that's usually like a faster way to equate it, right? Because how much are you selling it for later? Which I know this is kind of. Anyways, let me get back to trying to put this part into it. The dividends, like if you're gonna keep if the idea of selling cash secure put options on Dividend Kings would be you're buying it because it's a business that you want to own. You're gonna keep ownership of it. You're gonna what do business owners own businesses for? Most of the time it's for income. Otherwise, people tend to go into nonprofits. So once in a while, you do kind of mix being in business with something that you really love. But generally speaking, I think it's pretty safe to say usually if people want to do something they love, they kind of look at they do nonprofit stuff and they go into business because they need to make money to pay bills and maybe they want to have a surplus of money or whatever. So you're owning this as a business. Not only are you getting dividends, but you could be writing covered calls on it. And then it's like, what do you do with the dividend income, and what do you do with the covered call premium? Are you reinvesting into more shares? And so there's definitely kind of a way you could map it out. I don't do this at the Cash Flow Academy. Andy Tanner is. I hear him talking about this all the time though, but he'll like have your $100 or $10,000, and then every time you get a dividend payment, I don't know, let's say it pays $1. Now his cost basis is not divided by one. Okay, you pay out $10,000 for these shares minus the 43 bucks you got. So now your cost basis is here. You get a dividend payment, say it's $1, and this happens 4 times a year. So then let's just say minus that happens for let's say that was a bonus dividend and that happens 4 times a year. Let's say you get a total of $6 out of that. Now you just keep subtracting your cost basis, and then you sell covered call. It expires worthless. Now you whatever you're recouping money out. You keep pulling money out, and you're looking at every time you pull money out, you're getting back your $10,000 original investment because of the dividends, because of the option premium. You can start doing that a lot faster. And overall, yeah, that's a different way to look at it. And how are you going to do that? What's the option chain like? What are the dividends like? This company has a tendency to increase the dividends. So for me, I'd like to build positions in several Dividend King stocks because they're raising their dividend every year, and I'm giving a pay increase every year to help me keep up with inflation. I'm running out of time here though because I have which you are welcome to come to if you would like. Wednesdays, I'm doing these meetup groups. First one, stock options for beginners, and then that starts at 4:30 p.m. Eastern Standard Time, and then at 6:30 we have Make Money with Thinkorswim book study group. And so this is just straight like class education on options specifically, trying to help people get more familiar with options. There's no cost. Someday I would like to have a class where I could charge money. At the moment, I'm just gaining experience and learning and meeting people, getting myself out there and really learning how to help people understand this better, which of course is going to help me too. And someday in the future, I'll be able to have more organized content I can put together and sell and hopefully sell for a lower price than it's actually giving people in value. And then this one, I really like this a lot because this is um, this is we're going to be studying. Where it's a book club, right? It's a book group, book study group, but it's a Make Money with Thinkorswim book study group. So we want to use the knowledge to make more money with Thinkorswim. So we're going to choose books to help us make more money with Thinkorswim. When we study this book, we're going to be discussing what did the author say, not, and we're actively avoiding what we how we feel about what the author said, whether we think it was right, whether we think it was wrong, whether we think it's a good idea, a bad idea, what some of the unintended consequences might be. We're not really doing that. We're just looking at what did the author say, and we're doing this um, for a variety of reasons. This is going to be I know for myself, it is going to unlock things inside of me. It's going to force me to get more creative and think more empowered and more accurately. My critical thinking skill is going to go up ultimately, and I'm going to be making more money in Thinkorswim, especially when I can bring in a variety of people doing the same thing. It's not an easy thing to do, though. That's why we're doing it as a group to kind of help hold ourselves to some accountability. And so then what did the author say? This is a little inaccurate. I'll change that. I fine tuned it a little bit more. What did the author say? And then number two, what time did the author say it in? And number three, how can we use this information that what we're learning out of this book to make money in Thinkorswim? Now that third one, there's a lot of a room for any type of opinions. So we're starting on the first one with being like zero opinion, really, really tight, just exactly what did the author say. And then we're going to give it like a qualifier with then talking about when did the author say it. And we'll test out the waters a little bit. Maybe at that time it'll be maybe we should just keep it really like factual, or maybe we'll have it a little more open to talk about like what things, how things maybe the author would have said something different during a different time. I don't know. We'll not sure if we're going to do that. We'll play with it and see how the group likes it and go from there. But the last one is basically let's is there is the agenda, the rule on the last one, not the rule, the goal, the mission on the last one is how do we take this information and make money from Thinkorswim? So then the creative juices will be flowing. So check out meetup.com and find that group. Find these two groups if you are interested. I'll attempt to get better at putting these links in the description and all those type of things. So with that, you guys have a fantastic rest of your Wednesday. Aloha.